Red Flags Rule Compliance Training, presented by Identity Management Institute. This training will cover training objectives, the Red Flags Rule Regulation, covered organizations and accounts, red flag categories, consumer reporting agency alerts, suspicious documents, suspicious personal information, suspicious account activities, other notices and alerts, service providers, red flag detection and response, identity theft prevention program, and professional certification. Training objectives. In compliance with the federal Red Flags rule, all financial institutions and creditors with covered accounts must develop and implement a written identity theft prevention program to detect red flags or warning signs of identity theft in their business operations in order to prevent and mitigate identity fraud. This course will teach you about the regulatory requirements and techniques to create and implement an effective identity theft prevention and compliance program. Red Flags Rule. The Red Flags Rule is a United States federal regulation which requires that all financial institutions and creditors with covered accounts to maintain a written and updated identity theft prevention program to identify red flags in their business operations and take the necessary steps to detect and prevent identity fraud. Red Flags Rule Objectives. The final regulation lists 4 basic elements that must be included in the program of a financial institution or creditor. The program must contain reasonable policies and procedures to 1. Identify relevant red flags for covered accounts and incorporate those red flags into the program. 2. Detect red flags that have been incorporated into the program. 3. Respond appropriately to any red flags that are detected to prevent and mitigate identity theft. And 4. To ensure the program is updated periodically to reflect changes in risks to customers or the safety and soundness of the financial institution or creditor from identity theft. Who must comply? The Red Flags rule applies to financial institutions and creditors with covered accounts. Let's first define each entity. Financial institutions are Slate or National Bank, a state or federal savings and loan association, a mutual savings bank, a state or federal credit union, or any other entity that holds a transaction account belonging to a customer. Creditors include finance companies, automobile dealers, mortgage brokers, utility companies, and telecommunications companies, nonprofit and government entities, which defer payment for goods or services and are also considered creditors. Who regulates companies? Most of the financial institutions are regulated by the federal bank regulatory agencies and the National Credit Union Administration, NCUA. The Federal Trade Commission, or FTC, regulates most creditors, as well as state-chartered credit unions and other entities which hold consumer transaction accounts. Covered accounts. A covered account is a high-risk account, used mostly for personal, family, or household purposes, which involves multiple payments or transactions. Covered accounts include credit card accounts, mortgage loans, automobile loans, margin accounts, cell phone accounts, utility accounts, checking accounts, and savings accounts. A covered account is also an account for which there is a foreseeable risk of identity theft, such as small business or sole proprietorship accounts. Identity theft red flags. Suspicious patterns, practices, and activities that indicate the possibility of identity theft are called red flags, which must be identified, detected, and mitigated to reduce the risk of identity fraud. Red flag categories. There are 5 red flag categories to which we must pay attention. 1. Alerts received from consumer reporting agencies. 2. The presentation of suspicious documents. 3. The presentation of suspicious personal information. 4. unusual and suspicious activities, and 5, notices and alerts received from customers, law enforcement authorities, service providers, or other persons regarding possible identity theft. Consumer Reporting Agency alerts. Consumer reports often include information which can be used to detect identity theft. Such red flags include fraud alerts placed by consumers, notice of credit freeze in response to a request for a consumer report, notice of address discrepancies, and unusual patterns of activity, such as a recent and significant increase in the volume of inquiries, an unusual number of new accounts, a material change in the use of credit, especially with respect to recently established credit relationships, or an account that was closed for cause or identified by a financial institution or creditor for abuse of account privileges. Suspicious documents. The following must be considered as possible document red flags. Identification documents or applications appear to have been altered, forged, or reassembled. The photograph or physical description on the identification is not consistent with the appearance of the applicant. Information on the identification is not consistent with information provided by the person, and information on the identification is not consistent with readily accessible information on file, such as signature cards or recent checks. Suspicious Information Part 1. The following must be considered as possible personal information red flags. Personal identifying information provided is inconsistent. For example, Social Security number or SSN is other than 9 digits, or zip code does not match the address. Personal identifying information provided by the customer is not valid. For example, phone number, address, or Social Security number does not exist, or SSN is listed on the Social Security Administration's Death Master File. Personal identifying information provided is associated with known fraudulent activity. For example, the address or phone number on an application is the same as the information provided on a fraudulent application. Suspicious Information Part 2. The following must also be considered as possible personal information red flags. Duplicate SSN. Phone number or address provided exist and are the same as the submitted by other persons opening an account or existing customers. The person opening the account or the customer fails to provide all required personal identifying information on an application or in response to notification that the application is incomplete. And the person opening the account or the customer cannot provide authenticating information, which would normally not be available in publicly available sources or stolen items, such as wallets and account statements. Suspicious Account Activity Part 1. The following are account activity red flags. The institution receives a request for a new, additional, or replacement card or cell phone and users within 30 days of a change of address, in which case the company must first validate the new address. Transactions are associated with known patterns of fraud, such as the majority of credit available for cash is used. The majority of available credit is used to purchase merchandise that is easily converted into cash, such as electronic equipment or jewelry, or the customer fails to make the first payment or makes an initial payment but no subsequent payments. Suspicious Account Activity Part 2. The following are also account activity red flags. Account usage is inconsistent with established patterns of activity, such as no payment is received when there is no history of late or missed payments, a material increase in the use of available credit or cell phone account, a material change in purchasing or spending patterns, or a material change in electronic fund transfer patterns in conjunction with a deposit account, a covered account that has been inactive for a reasonably lengthy period of time is used. Mail sent to the customer is returned repeatedly as undeliverable and transactions are occurring. The company is notified that the customer is not receiving paper account statements, and the company is notified about unauthorized transactions. Notices from other parties. Your company may be contacted and notified regarding identity theft by various sources, such as other companies, persons, law enforcement, and customers. These notices and alerts must be taken into account and followed up to ensure they are resolved and do not affect other accounts. Service provider considerations. When your company outsources its operations to a third-party service provider, your company is still responsible for identity theft and must ensure that the written agreements between your company and the service providers require third parties to have reasonable policies and procedures designed to identify, detect, and respond to identity theft red flags. Share its identity theft prevention program at the request of the company and communicate major incidences and/or control deficiencies which may adversely affect the company and its customers. Fraud detection summary. Policies and procedures must consider the following general fraud detection guidelines. Obtain and review customer identification documents and information. Authenticate customers whether transactions occur in person, on the phone, by mail, or online. Monitor transactions for suspicious activities. Follow up on alerts, notices, and suspicious items. And validate change of address requests. Red flag response. Consider one or more of the following options in your policies and procedures when employees detect a case of identity theft. Monitor the account for evidence of identity theft. Contact the customer. Change any password, security codes, or other security mechanisms that may permit access to a covered account. Close the account. Reopen a closed account with a new account number. Do not open new accounts. Do not attempt to collect on or sell a covered account to a debt collector. Document all relevant case information. Notify management and law enforcement, or determine that no response is warranted under the particular circumstances. Program considerations. Consider the following for managing your identity theft prevention program. Assign an oversight person or committee. Assign a program manager. Formalize an identity theft prevention program in writing. Provide the program by the oversight party initially, and when the program is materially updated, perform periodic risk assessments to identify covered accounts, identify threats, and consider service providers. Develop policies and procedures to identify red flags, detect red flags, and respond to red flags. Update the program periodically. Report program status to the oversight party annually. Train all appropriate employees and consider the Federal Financial Institution Examination Council, or FFIEC guidelines for online authentication. Employee response. In case an employee has questions or does not know what action to take, the employee must be instructed to refer to company policies and procedures, contact his or her manager, who will contact the appropriate groups for expert advice and guidance, and based on the type of red flag, the appropriate groups together with the manager and the employee will determine the appropriate response. Professional certification. If you are interested in the leading identity theft prevention and compliance certification, consider becoming a certified red flag specialist. CRFS is a registered trademark of Identity Management Institute and is closely aligned with the U.S. Federal Red Flags Rule. Visit us at www.theimi.org.